What's going on, guys, and welcome back to the channel. Today's topic is going to be an in-depth guide on how to trade options on the Robinhood platform. Let's get right into it. So before you're even actually allowed to trade options on the Robinhood portfolio, you have to go to account, which is in the bottom right-hand corner. It looks like a person. Click on that. It'll bring up your investment portfolio, your portfolio value, the buying power, and all that. Scroll down. Keep scrolling down until you see options trading, get options trading. Click on that, and then sign up for free. Continue, and then click the options that best apply to you. After doing that, it'll say review your application. Click review. It'll scroll the whole way down. Click submit application, and this is where it's going to verify you and actually allow you to trade options. So after this is done, it'll say upgrading your account. And once that's done, congratulations, you're all set to trade options commission free. You've been approved for the following trades, and this is what you're approved for. So now it's time to actually get into trading options. So how you do that, you go scroll down, pick a stock of your choosing. For example, we're going to pick AMD. You go to trade. Now, before you actually go and get your application reviewed to do options, you will not see this trade options button. All you will see is buy or sell if you actually own that stock. So you have to do that first in order to actually even be able to start trading options. So click on trade options and then go here and you'll see all these dates up here, and you're probably asking what they mean. Those are the expiration dates on when option contracts will expire. So click on one of them, and this is called your option chain. You're going to see a bunch of prices here, and this is basically what you're betting that the price is going to get to at a certain time by that certain date. So January 17th is what we selected. A call is basically betting for it to go up, and a put, the puts are different, and they are betting it to go down. Now, if you take a look on the right-hand side, you'll see $49 put, $48.50 put, $48 put, $47 put, and it goes down, and this way it goes up. Now, what that's called is your strike price. That is the price that you're betting that it's going to hit by your given date that you're on. So if you look at the right side then, you'll see next to that $49 put, you'll see $1.50, $1.19, 92 cents, 70 cents, 52 cents, and so on. That is the premium that you're actually going to buy. Now, in order to buy one contract, you have to buy 100 shares. So that is the price per share. So on the $49 put, one share of that is $1.50. However, you have to buy 100 of them in order to get that $49 put, because one contract is equal to 100 shares. So $1.50 times 100, because of the 100 shares, would be $150 that you would be paying for each contract of that. So let's go in and actually look at that. So let's just purchase one contract, and the price is $150. And you can actually see underneath there where it says contracts, it says times 100 shares. So no matter what, whether it's a call or a put, we'll go into the calls and I'll show an example of that. It's also 100 shares. So it's the same thing. And this is 68 because this is the one that I clicked on was 0.68. Now, unfortunately, options are a little bit more complex than just this. So if, for example, let's click on the $49 call real quick, and you see where limit price is. In green letters right underneath that, it says bid, and then there's two numbers next to it, and then there's ask. Let's click on that, and we'll scroll down. Now, the Greeks are really important, and I'm not going to go too in-depth into this right now. However, basically, I'll give you an overview of what they are. Delta is essentially for every dollar that, or every point that the stock price goes up, the options contract will go up by 0.39. So if AMD right now, it's at, as you can see at the top there, it's at $48.20. If we go back into this, if it goes up to $49.20, your option contract, instead of being at 68, will be 0.3910 cents higher. Now, Gamma goes very hand in hand with Delta. Now, also, I might add that these are both changing with the stock price moving. It's not just going to move up $1 and then boom, it's instantly going to be up. They're slowly going up. So Delta, Gamma, and Theta are all moving as the stock price is moving up or down. They will move up or down according to what the stock does. Now, like I said, Gamma does go hand in hand with Delta, and how that works is for every amount that Gamma goes up, Delta will move up too. So, for example, let's just say we say that AMD goes up to $49.20, which is $1 higher. Gamma, which is right now at 0.1511, $1 higher will put Delta up that amount. So instead of Delta being at 0.3910 at $49.20, which again is $1 up, it will be at 0.5421 because all you have to do is just add them both together. Now, like I said, it's not going to instantly do that after it goes up $1. It's going to gradually move up the more that it moves up. But statistically speaking, if AMD were to be $1 from now, Delta would be around that point. However, theta is negative. And you see theta there, for every day that passes by, theta is depreciation, time decay. Time is against you when you have calls and puts, naked calls and puts, I should say. So what theta does is for every day that goes on, the stock option price, which right now, if we take a look, is 0.68, will go down whatever theta is. So it's at 7 cents right now. So let's just say AMD didn't make a single move. Now, what happens is that will move down 7 cents from where it's at. So instead of the option contract being at 0.68, it would be at 0.61. Now, that is really the only thing you really need to know about the Greeks. There are Vega and Rio, but they're really not as important as Delta, Gamma, and Theta. That's really all you need to know for the basics. We can get into that if you guys really want to know about that, about volatility and how volatility affects options contracts and how it affects the price movements of option contracts. Just leave a comment down below and I will get more into that. So one thing you have to understand is in the money and out of the money contracts. What that means is if your contract is in the money, you can see $48 is below the share price right there in the very center. It says share price $48.20. That means it's in the money. And the reason it's in the money is because it's already hit that price. So all of these, if you scroll down, are in the money. And all of them, if you scroll up, are what's called out of money. And as you can see, the options contracts, the premium that you're paying is actually going to be a lot cheaper just because it gets that much harder to hit and it's that much less likely to hit. And if you keep scrolling down, they're going to be more expensive because it's more likely that it'll hit that price. Now, as you can see, it's the exact same thing for the puts, except it's flopped. So since you're betting for it to go down, it's more likely that it's going to hit these numbers up here, so it's more expensive, and it's less likely that it's going to hit these numbers down here. That's why it is less expensive. Now let's take a look at an example of a stock that dropped a good amount, 4% today. So if you go into the options here, and we'll go to the January 17th, we'll go into the puts since it went down much. You can see that most of these are above 90%. That means you can make, if you invested at the very end of the trading day before the day that this happened, you would be up 98%, 93%, 95%, 97% up on your money. The last thing I'm going to add is you have to be careful. Options are extremely risky and you can lose all of your money in just one single day. Please make sure you know how they work and go in depth on paper trading with them before you go and use any of your actual money. Also, be willing to lose the money you go into on a trade just in case the worst scenario happens. Alright guys, hope you liked this video explaining how options work on the Robinhood app. Please be sure to subscribe, like the video if you did, and post a comment on your thoughts, maybe a suggestion on what you would like to see next. That does it for me, guys. I'll see you later.